Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your clients money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?
Alright, hi guys, welcome to the channel, welcome back. So today I'm going to doing something a little bit different because for those of you who follow the channel a lot, you know I talk a lot about market profile. I talk a lot about generally a holistic strategy in terms of generating income for yourself and ways to look at the market from a swing trading perspective largely. And again, for those of you who are interested in intraday trading, you would see that I have some content on this channel on the best way to do it. I don't do it as much because I feel you generally get the same amount of volatility whether you're doing it or not. I think day trading just adds to the churn, which means you just spend more commissions doing it. I don't really think it gives you a bigger return, but obviously that's just me. And it's also going to be relative to the asset you trade. Now, of course, my edge lies in being able to look at these things and swing them largely. And one of the other things that I do here is sell options. Now, I have got a ton of content on selling options, and I tend to promote that a lot more in terms of the best way to come at the markets if you're going to trade options is to sell options. Now, I'm not completely against the idea of buying an option. It's just that I find that it's incredible. Options are decaying assets, so you gotta what's the word, you've got to manage the theta button. So in other words, you have to be very right to make money on a long option position, whereas I find that you don't even have to be right to make money on a short option position. So I prefer to sell the options. Now, in selling the options, I think it's important that you have the right tools, and that's why you can see here, this is my general platform for selling options. So this is where you will find me looking at what option strikes, what calendars I would like to sell. I'll be looking at the different strikes and I'll be deciding what strike to sell based on what I can see here in terms of volatility, IV, standard deviations, and so on. Right, so obviously I treat my option trading like I'm a professional. I do have an industry background. Whilst I don't see the market generally like some of those other industry professionals, I'm not here trying to rake money out of people. What I'm trying to do is give you an idea of how I look at the market and how I do it, and why I think should be beneficial to you, and it will give you a certain degree of edge as someone who's probably a retail investor. You know, if you're watching this video, you're probably a retail investor. If you ask my honest opinion, I personally think that retail investors are far more serious and capable when it comes to trading than professionals. Now, a lot of professionals will agree with me, especially ones that are really good at what they do. They'll probably agree with me. And the other thing you've got to bear in mind, the wealthiest people in this business are not necessarily the smartest, right? It's just that we live in a world where if you can attract a lot of capital, then ultimately that capital could be multiplied exponentially, right? Because it's just the way money works. As they say, your first 100k is the hardest to make, but once you've made that first 100k, you can tend to make a lot more within a shorter space of time, and that's largely because of the compounding effect. So when people who have access to a lot of capital always appear or seem to be smart or smarter than those who don't. But to my career, what I've seen is people who don't have a lot of capital tend to have a lot more to lose, so they put more effort and they find edges that even they don't know that they've found, because their professionals will easily tell you, well, that's ridiculous, because why do you even need to do that? Why does that even work? Well, it stands to reason they've never done it, so they don't know. Right? That's the bottom line. They don't know, but they have to always seem to be smart. So they're going to tell you that they know. They're the best people to go to, and you see them all the time in social media who people who want to cash in on the new media wave are going to be out there pushing themselves as professionals, when we're really just talking about a case where they just had a little bit more money to start off with than most other people, so they were able to grow that more exponentially, in some cases not even using any complicated strategies, or they didn't even need to risk manage. Basically, they were just able to grow that fairly easily. So it's just the world we live in. The more capital you have, the faster you can grow. Of course, not everybody started this way, and I'm very mindful of that. So a lot of the strategies that I've focused on in my time are the ones that retail investors are likely going to find themselves needing to focus on. Because if you can focus on a strategy that has high edge, that you've put a lot of work into, or you can focus on a research area, particular idea, for example, that Wall Street is not going to be focused on because that's just not where their edge is, then you're going to be in a much better position. So going back to my earlier point, retail investors put so much work and time and effort into investing. They got so much screen time, even more so than professionals, that there's no reason why as a retail investor you shouldn't be more successful than an institutional investor or institutional trader, let's put it that way. And yeah, I mean, some people disagree with me, and that's perfectly fine. But from what I've seen, through my time in the industry, is that retail investors are incredibly smart, mentally equipped to do this. I just think it's a question of lack of belief. So anyway, a lot of this channel, what I do here is to kind of really cater to that audience, to get them to see, well, you're on the right track. I guess you just need someone to tell you that whether you're on the right track. So anyway, as I always say, support the channel, like, subscribe. That helps the YouTube algorithm know that we're doing something good here, and we're more likely to get more attention. We'll be able to help more people. All right, so I've diverged a little bit. So let's reel this all the way back to selling options. Right, so first thing you need to understand, I've got a ton of videos already on options trading that you can look at. I've got a free course here on YouTube, if you go through my channel, that you can watch, that already covers options. Now, one of the things that you want to be able to pay attention to or be able to understand is what we call the options chain. The option chain just lists basically call options and put options, and it basically tells you those in the money, those out of the money on either side, and then you can decide what strike you want to sell based on the premiums available. So it's actually really straightforward. I mean, nothing could be simpler. So the basics are really easy to grasp. You've got calls, you've got puts. Do you want to sell an out of the money call, which will be all the strikes here? Do you want to sell an out of the money put, which will be all the strikes here? Or do you want to sell an in the money put, or do you want to sell an in the money call? There are ways you can decide how you're going to do that. And it's all down to how much premium you're going to be able to collect. Like I said, we're option sellers. And then we have the calendars. So we got, every week, as you can see, these options expire. So you've literally got a week, if you sold an option, for that option to stay out of the money and expire worthless. So you can get to collect the full premium. So this is what it looks like. So if you're looking at my chart here, you can see I've sold Micron puts, which means I'm bullish on Micron. So whenever you sell a put option, it means you're bullish, because what you're basically saying is that the price is going to stay above your strike price. Because if it finishes below your strike price, then it tends to mean that if the option expires, then you'll be assigned. So basically you'll be assigned stock at a price essentially below your strike price. And that's, you take a capital loss, because you have to basically own that stock and sell it back into the market at the price it's trading for. Well, that's the downside, is that you're exposed. As an option seller, you are exposed to the entire stock. But it doesn't mean that you're going to get assigned, because you can always close the trade by basically buying back the option. So even though you sold someone an option and you've collected the premium, you can always go back and buy the option again at the current price, and then separate the difference between what you received in premium and what it cost you to buy the option in the open market. So you can get out of these trades, so you can close them. That's the point. So most people do end up closing their option trades. Some people trade options like a stock basically through the day. So hence why there's so many videos online about, oh, I'm an options trader, make billions with it. Because options are generally looked at as leverage tools, right? Because each option contract essentially entitles the individual or the holder to 100 shares, right? So the multiplier is 100, and you can see that here, that 100 here on my screen for Micron. Yeah, that's the multiplier. So if the multiplier is 100, then you're entitled to 100 shares, right? So that means that for every option contract you're holding, you're entitled to 100 shares. So you're going to have exposure to 100 shares at any given point. And that might be challenging for some people, but it doesn't necessarily mean that it's not doable. And when you're selling options, the margin requirement is higher. So a lot of people don't want to sell the option, because when they sell the option, they realize, oh God, I've locked up so much capital just to sell, 10, 20, 30 contracts, right? And for some people, that's painful. So again, it just depends on how much money you have. I always say to people is that if you have a lot more money, right, and this is not financial advice, but if you had money, then you should explore looking at options, right? Because it's in my opinion anyway, it's an interesting way to sort of multiply your capital with very little effort. All right, so let's look at this now in practical terms. I'm going to open up this chart so it's a little bit clearer. So the first thing you notice that this is my option chart. So this I focus a lot on options 3 DTA, right? So options of 3 days to expiry. So what we're talking about is options that are maybe trading on a Tuesday or Wednesday with expiries on Fridays, right? Those are my most interesting ones to look at. So again, the further out in time the calendar is, so let's say it's a 30 day option or 30 days to expiry, the premiums are going to be a little bit higher, right? Because there's still time value in here, is what we call extrinsic value. So there's still extrinsic value. I focus a lot more on out of the money options, which don't have any intrinsic value. So that means essentially those options are out of the money, so they don't have any value that can be based on the value of the stock, right? So it's just time value. Because options decay over time, we have to factor that in. That time erosion that eventually occurs as the option nears expiry is what we call theta, right? So theta burn. So if the theta is always deducting value from the option. So generally, because options decay, it's kind of smart to sell them. And that's kind of why I sell them. Again, if you look on the 2nd of January, this option was trading $1.65, and while it expires today, it's trading 5 cents. So you could have gotten away on the 2nd of January, the 12th today. You could have got $1.65 for, let's say, 10 of these. What that essentially means is that you're going to have $1,660 in premium, right, which you can just take and walk away. Well, today it's expiring at 5 cents. You can either buy it back at 5 cents, right, which will close out your option position, and then you would have that profit as a net acquired profit that now you can spend, burn, put back in whatever you want to do, right? Again, if you closed out the option, then you're free, or you can leave it till it expires today on Friday, which saves you a bit of money. You don't have to pay a commission to close out the option, which essentially means that the option will expire and the money will just stay in your brokerage account. So that's kind of what happens when you sell an option. You just collect the premium, so whatever the option costs. Now, of course, as you can see, for all of the option sellers over different cycles, right, there was no risk. So even if you were selling this option on the 20th of December, it was $4.17, it still expired in 5 cents. And this is because every single day, this option lost value, right? And there were times when it did pop up a bit aggressively, right, which scares some people, is that, imagine you'd sold at $4.17, you didn't buy back the option at 38 cents, and then it pops back up to $1.62. Some people don't like to see their P&L go up and down in this way, reflecting. But in the long term, what you have to bear in mind is that that option is likely to expire worthless. There's a 85% chance it's going to expire worthless because it was out of the money to start with. The 81 puts were out of the money. Micron is trading over $81, and that's all we need to happen. And even if it isn't trading over $81 on a Friday near expiry, the chances that it's still going to be trading at $4.17 from the 20th of December is very, very slim, right? So in the end, even if the stock is rising slightly in price, the fact that there's theta burn on these options is going to mean that options are not things people are going to want to hold too long term, especially if you're looking at a 30-day option. You only got 30 days on the thing, right? So, you got to make a decision within 30 days. So in my opinion, that is a forcing point to anyone who's holding these options long or short. They're going to decide, and that's going to have an impact on the stock, right? So it's going to restrict how far the stock can go over a given period of time, and it's going to restrict whether it's going up or it's going down. It's going to restrict it because of the way these options work. And because there's so much money going into options, you're probably going to see the impact on the option first before you see it in the stock, right? When we're looking at this, these high points are when we started to see investors flow in. So whenever you're looking at an option chart and you see the option premium spike, especially put options, and point in case, put options spike a lot more because people are nervous. People are scared of risk. So whenever something goes wrong, put options get really expensive really fast, but they tend not to stay there. Right? And what that means is that eventually people realize that the worst is behind them. So they very quickly start to unwind their put insurance, as I like to call it. Right? So they're insuring themselves in the case, because again, people hold these stocks as an investment. Like some people hold them in this stuff for years. So if people buy puts, it doesn't mean they're going to sell their holdings. It just means they're trying to protect their holdings. So puts are always, for me, puts are the best target to sell. I don't like selling calls because stock prices can go to infinity. So if you sold a call and, let's say we got an Nvidia type move, then you're in trouble, basically. So
money talks. Bullshit runs the marathon. So, see ya, and I wouldn't want to be here.
To avoid all of that, I tend to focus a lot of my attention on put options, right? So I sell puts more, in other words, right? So again, and also the market has a bullish bias. I think we all know that goes rather without saying. So we put some of this stuff back into perspective. So you've heard me talk about the higher probability of selling an option than buying one, the focus on put options because people always over exaggerate risk. So when they do that, these things go a lot higher than they should go. So they get expensive quickly, but they also unwind very fast. And if you're looking at this chart of Micron, you can see very quickly how Micron got expensive to $1.65. I mean, we literally moved from about 36 cents to $1.65. The argument is, well, if I bought it at 38 cents, then I would have made a lot of money. But you don't know that. That's the point. You didn't know that they were at 36 cents all the way down. This is a lucky move, and I don't want to just be lucky. I want a more sure bet. So by selling the option, if I see the move, I can sell it because I kind of know that something's going to happen through the course of a week or 2 weeks that is going to cause a spike in option premiums, right? So I just look for liquid stocks, specific names with a certain IV or implied volatility. So I like anything 27, 30%. Sometimes 40, 50% IVs are good, but you just have to be able to sustain the volatility as things bounce up and down. So so I like to sell them, in other words, right, when they get expensive. So in this case, you can see that we had a brief pop up here, a bit of flow on the 5th of January. That was a good selling place. Again, if you like to deal with things that are like a week out, this was like 4th of Jan, that was a good sell, right? Or you might prefer to deal with things that are closer like I did. And then you can see that here from my positions. that I prefer to do that, right? So you can sell quite a few contracts there, collect the premium up front, and then wait for the thing to go down to zero, right? Because I'm looking at 2-3 DTE, any spikes I know are short-lived, and even if, let's say, miraculously we, Micron did end up below $81, it wouldn't be that much below. And because so much theta is going to be burned out of these options at this point, it means that even if it's about to expire in the money, you can easily close your trade on a Friday evening, for example, in the case of, because I live in the UK, but you could close your trade, let's say Friday lunchtime or just post lunchtime before the markets close, and still be able to get out of that option for maybe break even or maybe a small gain, right? People have seen this. For guys in my Discord server, you've actually seen time and time again, we're not always right about where these things are going to go. We sold an option and it was about to expire more or less in the money, and we just closed the trade and collected a small credit, maybe 20% of the credit we would have collected. In some cases it's break even, in some cases it's 5% of what we would have collected, in some cases it's even more, in some cases almost 50% of what we would have collected, right? So we're still collecting credit, or let's use the word premium, but we're not collecting as much premium as we could because we're buying back the option, maybe say here at 28 cents. So let's use a common example. Today's Friday. This option is going to expire worthless. I've sold quite a few contracts between sort of 45 cents and 52 cents to 3 days to expiry, right? So I'm sitting on a bit of weight, and they're about to expire worthless. Now let's say for whatever happens, some crazy stuff happens today and these options spike up. Well, by the close of the day, even if they were going to go all the way back to 45 cents, I got a couple of options. I can put a break-even trade here and say, well, look, get me out of this option at 41 cents and I'll get a small credit. Or I could say to myself, well, you know what, there's a slim chance it's going to close below 81. So I'm just going to wait. And the chances are that I'm going to be able to close this for maybe 20 cents just before, well, slightly before market close. I like to make that decision sort of about 6 to 7 o'clock in the evening, my time here in the UK, which is about, the US is 5 hours ahead by New York time. So that gives me an idea that, okay, so sometimes it might be trading at 20 cents, but I can clearly see this thing's going to finish in the money. So I just close it and then I'll make a small gain as opposed to holding this till expiry. So that's just a way of risk managing, right? So that's some of the methods that I will employ when I come into the phase of selling options. Now, and there's a reason this happens, is because the option contract, whatever happens, is either going to expire worthless or it's going to expire in the money. But either way, it's going to be gone. It's not going to exist. And because it's not going to exist in about a day or two, it means that people in this contract are going to make a decision. Because they're puts, no one really wants to assign their stock anyway to someone else. Like, they don't want to put the stock away. Crap, this is Micron, right? They might feel like this thing's going to be higher in 10 years time. So it's, for me, it's a safer bet playing in puts, right? So you will generally see me sell puts a lot. But here's an example of effectively how I sell puts, why I do them, and what that looks like. Again, guys, this is the first video that I'm doing here on selling put options, and I hope through subsequent videos you guys will learn a lot more and you'll be able to do this yourself, because it's not very difficult to do. I think the thing we want to bear in mind is it does require a lot of capital. And if you're going to sell, say, one put option contract on like a big stock like Apple, you essentially need to have cash plus margin, the capital required to hold the entire stock if needed. So it will deplete your margins really quickly. So Micron is over an $80. It's over my strike, so it's an $81, $80 stock, about $82. As you can see, my strike is 81. So depending on how many contracts I have, I might need a lot of margin to be able to cover that, right? And so it can be a bit cash restrictive, but it is what it is. Anyway, guys, till my next video, adios.
Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your clients money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention. mansion.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April week. What do you think, Valentine?